Welcome to the Nest Edge March edition. I hope everybody's enjoying the weather. It has been a nice relief from what we saw a couple of weeks ago. Hope everybody made it through the winter storm without too many hangups. I was actually out of water for 100 hours, which is crazy. But it gave us an opportunity to get together with family and have some extended family time. So that was really good. So thank you again for joining us on our Nest Edge March. We named this Nest Edge because it's a unique way of looking at data. We have a unique way of looking at data that gives us an edge over the choppiness of the markets and news cycles especially. I do want to say before we get started, this is not advice. When Sean and I speak, it is mainly a conversation between he and I, and it's an educational webinar. Use this education to help you make more informed decisions. And again, also just to show you how we do things as a firm. I do realize that in this game of investing, there are many, many ways to win, and there are many, many ways to lose. We are just discussing our process of how we have done it with our experience and what we've learned along the way. And hopefully it's a good education for you. For those of you that have listened to our webinars before and would like to move forward in building your portfolio with us, please reach out to us at info@nestfinancial.net. We'd be happy to get you on a call and discuss what the next steps are. I recently read where everyone knows 152 people on average. If someone in your circle needs to grow their knowledge in the financial arena, please send them our webinar links. These are open to the public. This is how we introduce ourselves to new clients through our works and our conversations. So please feel free to send this webinar link along. Again, this is a conversation between our portfolio manager, Sean McDougle, and myself, and inclusive of our audience. So if you have a question, please make sure to add it to the questions in the Q&A on the side, and we'd be happy to address them. Sean, once again,
Yes,
it's been a heck of a month, new things happening, and I want to discuss, first of all, we'll catch up on what we discussed last month, but also, the things that are going on this month, which is a little bit wacky.
Never boring. Yeah.
Let's start off by talking about the stability of the markets after we saw last few weeks. In your newsletter, and so we always go back over your newsletter and kind of expand on it. In your newsletter, you talk about a new narrative in the equities markets. So I want to just talk about why there's this new narrative. Why did the change happen?
I don't, why the narrative is there now and wasn't there before, I have no idea. Their financial media is very reactive, and then that they are talking about what's already happened and have very little foresight. And I mean, like the whole mania of, oh God, Treasury yields are going up, the world is ending. Like yields have been going up for 6 months. So I don't get why all of a sudden now it's on their radar. It's comical at best. I don't know. I don't have a good answer for that.
Well, and for our audience, this is one of the distinctions where data is important. Data is one of those things where data versus news, we want to make the distinction. We have been talking about this type of data for, as Sean mentioned, 6 months about treasuries going up. And just now seems like news cycles is like really making a big deal about it. So since about 2020, summer of 2020, Sean, we have talked about growth and inflation taking off. I remember that on several occasions, you talked about a year-over-year comp, like a comparison of what happens this year versus last year. And just to kind of explain comps before I ask the question for the audience, a comp is every quarter businesses are asked to do how they're doing for the year. And every quarter it's measured and mapped. And so if you do well one year and you don't do as good the next year, no matter how well your stock is doing, it's seen as the market as a leading indicator, and it will affect the stock price. The issue is that this time last year, COVID hit. And so markets were just taking a dive. And so what we're going to see for the next 3 or 4 quarters is really bad comps because of what happened last year. So anything that's above that this year is going to look very well. So I wanted to explain what a comp or a comparison is when we talk about it. So Sean, the question to you is, does this have anything to do with what we're seeing in the markets today, the comps?
That the volatility kind of reappeared the last few weeks? No. If
Yeah.
the easiest comps we're about to walk into, that really hasn't been talked about much because year over year, you're right. Everything is going to look real good. I mean, if the S&P 500 was flat for the next 90 days, its 1 year growth rate is just going to keep going up because it's comparing to where it was a year ago. All that being said, I mean, there's a couple of things that are moving things around. The US dollar was rising. That's not good for domestic equities. Treasury yields were rising. That's, that on the surface level, it should be a signal that the economy is recovering because that's kind of what treasuries are. They are a flight to safety. People get scared. They run to treasuries. Things look good. They run away from treasuries. The problem, like I said, on the nest edge is treasury yields, and that's like in English, the dividend that a treasury pays out relative to its price. It's increasing. So if I'm just going to start making up easy numbers. The treasury yield is 1%. A lot of loans are denominated in that. But in the contract they'll say it's whatever the 10-year yield is plus 2%. Mm-hmm. So if the 10-year yield keeps creeping up, that amount that interest that people are paying for whatever loan is going up. So it's not great for, where we are as an economy, which is in a pretty fragile place.
The treasuries is one of the things that affects more than just people that invest in treasuries. You're saying invest in anybody that's lending, or most people that are lending are affected by treasuries.
Yeah. Massively important. Mm-hmm. Massive treasury yield. The 10-year yield is the Fed is aware of this. I expect that the Fed's going to even more ramp up their bond buyback programs to kind of cool this down because they know, Powell, who's the head of the Fed, he is very aware of this. So they're not going to let this get out of control. So I'm not worried about it. But at some point, the business world needs to understand we can't keep interest rates at zero forever.
Right.
I mean, that's part of the reason we've created this bomb at some point that's going to go off in equities is because it's just based on and cooked in all of these expectations that rates are never going to go up ever. At some point, there has to be a normalization. I don't know when that's going to happen, but if the expectation is zero forever, it's just not realistic.
Not realistic. So besides people that are lending, and I just want to emphasize on this because when we talk about treasuries, a lot of investors would be like, well, I'm not invested in that, or right now I'm not doing that. I'm just doing equities. How does treasuries affect the equity market?
If it's more expensive to borrow money, you're less likely to borrow money and invest in your business or hire people or buy that business. If it's harder to get loans or it's more expensive to get loans, people are less likely to borrow money and invest that in elsewhere things.
So we're talking about the equities companies themselves. So if equity companies if it's more expensive to borrow, and we know that treasuries affects the borrowing rate, they're going to maybe not do those things and maybe not expand as quickly. Yeah.
And it's all speculation at this point. I mean, for sure. Equities is trying to price this in, and you really don't know what's going to happen. It's just it's a mess, in my opinion.
Let's talk about money flows and why that matters. And when I say money flows, people moving in and out of treasuries. Can you talk about the impact of that?
I kind of hit on it. The 10-year is a safe haven. It's viewed as it's the safest debt in the world. The U.S. has never defaulted on any of their bonds ever. So globally, there are multiple reasons why the U.S. bonds have value, but it's just the simple one is you can view it as it's the safest thing out there that you can put it in other than underneath your mattress. But even then, if your house burns down, 10-year bonds are the safest thing out there. So when people are scared a year ago today, everybody's buying treasuries like crazy,
including us. We were heavy on treasuries.
Yeah. We had been in bond treasuries forever. Since September of 2018 is when we started our initial wave in. So we were very comfortably set up for it. You didn't want to be buying treasuries a year ago because it had already been overbought. But now we're starting to see the other side of that. Well, since, late July, early August is when yields bottomed and started turning around. And when yields are rising, that really means that price per treasury is going down. People are selling their treasuries. And I know that's confusing as hell. It makes no sense. But yeah, once it clicks, you'll understand the inverse relationship between yields and bond prices, but they go in opposite directions. If yields are falling through the floor, that means the price of treasuries are going through the roof and vice versa. Did that answer your question?
Yeah, no, it does. And so I think the point of that matter is for investors to understand that money's always moving from place to place in the market. And when things are really volatile, people flee to treasuries and gold. For those that are already in there, are making better returns as what we experienced early last year, because we were already in there. We'd already bought at a lower rate. And so when people come in, things get more expensive and we get to start selling at a more expensive yield. But when the markets start heating up and people start getting back into equities, then things start flowing the other way. So this money flow always happens. So this is just an explanation to the audience. So you mentioned in the newsletter that there are clouds in the horizon over the summer. And I want to talk about that because we've talked about that last couple of webinars. So right now we went from what, everybody's experienced in COVID and work from home and all the things that kind of depressed the economy at some point, have affected the economy. And now we're starting to see a lot more light in the tunnel, and you're starting to see a lot more movement. So in your newsletter, you mentioned, even though we're still going to see some positive movement and positive gains, and we've said this last couple of times, we also see things in the horizon, as in the summer. What are you seeing? What is the data telling you?
It's probable that things are going to really, really slow down. And this is, when I say probable, it's because of the year-over-year comps are about to get real, real difficult after right now, which is, they're super, super easy. When I say right now, I'm talking the next few months. Because let's call it, March, April, the economy globally, I'm talking 2020, March, April, May, the economy just stopped. I mean, we just grinded to a halt. Everyone was freaking out. We didn't know what COVID-19 was. The wind can give it to you. There were so many conspiracy theories out there. So everyone's staying at home. No one's going to work. Economic activity just stopped. So we're going to be comparing against that for the next few months. So things are going to look really, really good.
Right.
And then we had a massive ramp up coming off of those lows. And then we're going to have to start comping up against those. We're going to be comparing against those. And then you have the whole currency thing that's been pinging around. So there are layers to this. We don't know for sure what is going to happen. I just say it's probable that there is going to be the economic growth is going to start really cooling down late spring, summer. Equities can pull that in sooner, but don't think that's what's happening right now, which is the data is just not there to support that. But we will see, we've already started kind to see some of these major sectors go from bullish to neutral. Tech. It went neutral a couple of weeks ago. So that's okay, that's interesting. That's not to say it can't flip back to bullish, but it is definitely something that I look at every single day, is trying to figure out what are the trends doing, not just from a short-term duration, but midterm and long-term. Are they still bullish? Are they neutral, or are they bearish? But tech flipping a few weeks back was interesting.
So what happens, well, before I ask that question, I want to talk about tech for a second. You had mentioned this before, as things start ramping up, tech's going to pause because the correlation of those kind of markets. You don't want to talk about rising market and what happens with tech? We talked about that. So we talked about this, I think 1 or 2 newsletters ago, but it was where tech slows down whenever the rest of the markets take off.
Yeah, it is. And I'm generalizing things here, but usually it's the first one to rebound and the first one to slow down. It's the sharpest edge. So you're going to see it pop the quickest. And then on the opposite end, you're going to see it roll over the first, usually. But that is not a every time thing. That's just something that's interesting. It's something that it's possible that it happens, but it's not like a game plan. Like, oh, tech just rolled over, sell everything and go to bonds.
Right
now.
Yeah. And part of that, just to kind of explain some of the theories around it, is we think, why did tech do so well? We read stories all through 2020 where tech was doing really well, Zoom and other companies that made life easier to work from home, Amazon, i.e., those kind of companies. And as you start seeing that things are opening back up and a lot more hope for people having vaccines and things mid to late next year or this year, obviously, we've talked about the stock market being a leading indicator, and they're always going to try and price what's next. And so there's a natural slowdown from what they see as use. Doesn't mean that those companies are going bad, and doesn't mean anything like that. It just means that they want to shift money to where there's other opportunities that they might be able to make more money typically.
Yep.
What do we do? What are we thinking about over the next, in preparation for summer? Are we making any moves that are like, okay, let's go ahead and start slowing down, or what are the thoughts?
I mean, the only material changes that have been occurring lately is we're completely out of China. They were the first emerging markets that we got into. We're completely out of there. We have been starting to fade out on updates on tech, but we're not completely out of that. If I was to guess, again, I'm just guessing here because I don't know what tomorrow is going to bring. I would say commodities are going to be the next thing that will start fading out of when it gets to the top end of its range. Mm-hmm. And when it gets to the bottom of its range, we're not going to be buyers. So if I was to guess, if things continue the way they're going, we are going to, because we will fade out of certain sectors domestically. There are certain emerging markets that we have gotten completely out of. China, Japan's probably next that we'll fade out of. We are still in India, Taiwan, and then the Netherlands. Okay. But yeah, commodities will be next to go. And then the wild thing is, the few shorts that we do have, which were short gold and treasuries, we'll flip that. We'll go back long, go again. Like instead of being short them, we'll go long them again. That's, the timing of that we'll see, but the shorts will be going, I'd imagine, right around the same time we start really shifting the gears, because we'll go from at some point it's going to get real tricky picking that point, and you're never going to be perfect. But one way to play that is, we know treasuries are going to turn around at some point, or it's probably are. We don't know exactly when we want to buy them, so we'll for sure just take the short off. And okay, let's try to figure out our entry point going the other way to things. We want to ride this thing back down this summer. That's where it gets. For
those that don't understand short and long is buying. So gold and treasury, what Sean is saying here is at some point we're going to start buying gold and treasuries again, or adding some to our portfolio. But right now we're not. Short means you're either selling or thinking that price is going down. So we're not on the portfolios are not buying or having any gold or treasury. That's not our motive at the moment, but it's going to flip. And that's what, just to kind of put that into more layman's terms, because sometimes we just
Good job, Dan. Yeah, I'm terrible at that. If anyone's met me before, they know that I ramble, and they know Dan is great at cleaning me up, because I'm terrible at it. I just kind of get in my own head, and I'm like a little child in a toy store, and I just go. But yeah, you summarized that perfectly.
Before we go into our next question, we got about 10 minutes. So if there's any questions from the audience, please feel free to type those in the chat box, and we'll be happy to add those in. As we wait for those, since you mentioned having the best year in our most aggressive portfolio in your newsletters, can you give me some numbers for context? How are the portfolios doing year to date? Only 1 year, so on and so forth.
Check this morning, not including today. They're either flat. I think our most aggressive's up 0.5% today, but our most aggressive year to date's up just under 25%. Our most conservative is up 2%. So everybody's when we on average.
We compare that to what the S&P is doing, because that's a lot of people use that as the
live
measure.
It's up 3.7.
Okay. So when Sean talked about this, one of the portfolios are most aggressive. It's called the Alpha portfolio, up 25% when the S&P is up 3%. That gives you some context, because we want to illustrate that every portfolio, the way we manage portfolios, every portfolio's got something that we are a set rate of return that we're trying to achieve for the entire year. And so we don't on a daily basis compare ourselves or our portfolios to the S&P, because there are two different objectives. However, to put it into perspective, if an investor is like, well, how is that doing? If I'm just investing in the S&P myself, how is a managed portfolio doing differently? And we wanted to illustrate the differences because of the data and because of the things that we're doing the most aggressive, which is leverage. We're using some other tools in that most aggressive portfolio for some of our clients that's appropriate for, but it shows you the distinct difference on what can happen in the portfolios and how we're targeting them. So great job on working on that, Sean. I'm really proud of the work that's being done there.
Thank you.
Can you talk about the CRB Index and how that relates to inflation? Because you mentioned that in your article. I want to clarify for the audience what a CRB Index means and then how that affects inflation.
So the CRB Index, in English, it's a mechanism to track the prices of commodities. And when I say commodities, I'll just start ripping off what's in there. Oil, natural gas, gasoline, heating oil. Well, they do say gold is in there. Silver, platinum, soybeans. Orange juice, rubber, oat, wool, cotton, cocoa. Sugar, tea, corn. There's a bunch of things in there. The big one in there is oil.
Okay.
But it is a way to kind of get an idea of what commodities are doing. Are they rising in prices? Or are they falling in prices? And if you're not paying attention to that, that's when you get surprised. But all of these, and even Janet Yellen came out the other day, who is now ex-head of the Fed, now Secretary of Treasury for Biden. She was saying, we don't think inflation's there yet. I don't know how these people don't see this. If commodity prices are rising, that means input costs are rising. That always gets passed to the consumer every time. I don't get how these people don't see what's going on, that oil is up 10% in the last month, 32% in year to date. No, there's no inflation. What? What are they looking at? I don't get it. Gasoline's up 46% year to date. Yeah. So inflation is here.
Right.
It's the reason. It's the big reason our models have done so well this year is we have been, most of our models are 30-40% in commodities, and they love rising inflation, and inflation is ripping right now. And if it's just a massive mistake that people get, that they wait for the Fed to say, yes, inflation is here at 1.7%.
And then they react.
And then if you're waiting for them to tell you when to react, you've already lost. Game is over.
Makes sense.
So I promise you, I'm not the only one that looks at the CRB index.
Right.
I giggle to myself, but it's just wild that these respect. And I like Janet Yellen for the most part. It's just, but she's always waiting for more data to confirm inflation, no matter what. She's always doing that. Mm-hmm. And it just blows my mind how these people are much brighter than me, can't even look at this part and figure out, input costs are rising. I bet that means prices are rising.
Yeah. So the relationship.
Hot button for me.
There's a little bit of passion there. I can get it. I saw it in your newsletter. And that's why I wanted to tackle it. So the relationship, just for clarity for the audience, the relationship between a CRB index, which is the commodities, and inflation is that because when that rises, we know inflation is following. And so at the same time, in prepping for inflation, we want to be buying things like commodities because they love rising environments, and you're able to make more money during that. So for those that have seen things in your portfolio like soybeans, it's these commodities that have helped their portfolios stay afloat and have great returns during this time. Okay, well, it is 12:56. I don't see any questions this time, so evidently we must have either done a really great job or put everybody to sleep. We hope it's the first part.
I think I put everyone to sleep and it was too confusing.
Well, I want to remind everyone, first of all, I want to thank everyone for being here. And I want to remind everyone, this is not investment advice. As you saw, this is rather just a conversation between Sean and I, explaining the newsletter he just put out. And I want to just bring more reference points to the newsletter so that we have good education out there. And this is what we look at. It's education in nature. However, if you'd like to discuss how we do things for your portfolio, or interested in doing anything else we can do, like a financial plan or other things, please do let us know. We'd be happy to help. If after this you want to send this recording to someone, let me know. We usually have these recordings available a couple weeks after the episode once we've had time to edit them out. Once again, thank you so much for your attendance, and we hope to see you in a couple of weeks with our Nest Egg with Gloria and I. Until then, take care. Bye-bye.